Most retirement plans follow the same script. Work for 40 years, build a nest egg of $1 million or more, then spend it down carefully and hope the money lasts as long as you do. But that's not true financial freedom. It's simply living off assets you've spent decades accumulating. What if there were another way? What if a $45,000 investment in the right ETF today could grow to more than $1 million while generating a growing stream of income without selling a single share? In this video, we're putting Bobby's investing strategy to the ultimate test. His mission is simple but ambitious. Turn a portfolio into a wealth-generating machine capable of crossing the $1 million milestone while producing enough dividend income to replace a full-time paycheck. But which ETF has the power to deliver both explosive portfolio growth and meaningful passive income? I'll break down the 3 ETFs on Bobby's list. I will analyze their historical performance, and I guarantee you that the results may surprise you. Because while all 3 ETFs have strengths, only one emerged as the clear winner. Not only did it reach the $1 million goal, it crushed it. Even more impressive, it is projected to generate more than $7,000 in monthly dividend income, creating a powerful cash flow stream that could transform Bobby's financial future. If financial freedom is one of your goals, this is the video you do not want to miss. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Firstly, Bobby needed a target. According to the Bureau of Labor Statistics, the average full-time American worker earns about $1,235 per week. That's roughly $5,350 per month before taxes, or about $4,100 per month after federal and payroll taxes. That became the benchmark, not the portfolio balance, but the monthly income. So, Bobby's goal was to find an ETF capable of replacing that paycheck through dividends alone, while continuing to grow the portfolio year after year. 2 goals, 1 investment. The question is, which fund can actually deliver? Like many investors seeking passive income, Bobby's attention immediately turned to the ETF with the highest yield. After all, when you're trying to generate income, the highest paying fund seems like the obvious choice. That's when he found the JP Morgan Equity Premium Income ETF, ticker symbol JEPI. At first glance, this fund looks almost irresistible. It offers a dividend yield of approximately 8.46%, a figure that instantly grabs attention. Most dividend ETFs typically yield between 2% and 4%, making JEPI's payout more than double what many investors are used to seeing. For someone investing $45,000, the prospect of collecting a large monthly income check right away is incredibly appealing. The strategy behind the fund is actually quite clever. JEPI owns a portfolio of large, established US companies such as Microsoft, Amazon, and MasterCard. It then generates additional income by selling options on those holdings each month, collecting premiums from traders, and distributing much of that income to shareholders. On the surface, it appears to offer the best of both worlds, quality companies and an exceptionally high yield. But when Bobby looked more closely, the cracks began to appear. The first issue was the track record. JEPI launched in May 2020, giving investors only about 6 years of history. That's simply not enough time to evaluate how the fund performs across multiple economic cycles, recessions, and extended bear markets. The second issue was even more concerning. Despite its impressive yield, JEPI's dividend growth has been less than 1% over its history. While the monthly payments fluctuate with market conditions, the overall income stream has shown very little long-term growth. His goal wasn't just to generate income today. He needed income that could grow significantly over the next 20 to 30 years. Inflation never stops rising, which means a dividend that remains mostly flat gradually loses purchasing power over time. Then came the biggest drawback of all. JEPI sacrifices future growth in exchange for current income. Because the fund sells options on its holdings, it limits its upside when the stock market rallies sharply. When stocks surge, much of that potential growth gets capped near the option strike price. Investors receive income, but they give up a portion of the long-term appreciation that drives wealth creation. As Bobby ran the numbers, the conclusion became clear. While JEPI could generate an attractive monthly paycheck today, it struggled to build the kind of portfolio value needed to reach his long-term goal. A $45,000 investment simply wasn't projected to grow anywhere close to the $1 million target he had established. That's the hidden danger of chasing yield alone. A large dividend may look impressive today, but if the income barely grows and the portfolio struggles to compound, investors can end up trading away decades of future wealth. For investors seeking immediate income, JEPI may have a place in a portfolio. But for Bobby's mission of building a $1 million portfolio while creating a growing income stream that could eventually replace a paycheck, JEPI failed one of the most important tests. The yield was impressive. The long-term growth wasn't, so JEPI was out. Next on Bobby's list is the Vanguard S&P 500, ticker symbol VOO. When investors think about building wealth, this is the fund that almost always comes up in the conversation. VOO has become the gold standard for long-term investing, and for good reason. It owns 500 of America's largest and most successful companies, including Apple, Microsoft, Amazon, and Google. Over the last 10 years, VOO has delivered more than 250% in total returns, turning patient investors into substantial wealth builders. And to be clear, VOO is not a bad investment. In fact, for someone focused purely on growing their portfolio, it may be one of the best choices available. But Bobby isn't chasing portfolio value alone. His goal is bigger. He needs an ETF that can grow his money beyond $1 million while also generating enough monthly income to replace a paycheck. That's where VOO begins to struggle. Despite its impressive growth, VOO's dividend yield sits at just 1.05%. A $45,000 investment would generate only about $39 per month in dividends today. Even after 30 years of compounding and significant portfolio growth, the projected monthly dividend income would likely be only $100 to $200 per month. The portfolio would almost certainly surpass the $1 million mark. The growth box gets checked, but the income box remains almost empty. VOO was designed to build wealth, not to create meaningful cash flow. For investors seeking maximum growth, that's perfectly fine. But for Bobby's mission, VOO could not meet the goal of replacing his paycheck. Therefore, VOO is also out. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. After eliminating 2 ETFs, Bobby was left with one final candidate. Ironically, it wasn't the fund with the highest yield, the fastest growth rate, or the most exciting strategy. Yet it was the only ETF that satisfied every requirement he established at the beginning of his search. More importantly, it was backed by 14 years of real-world performance through multiple market downturns, giving Bobby confidence that its strategy had already been tested under pressure. The fund was SCHD, the Schwab US Dividend Equity ETF. SCHD tracks the Dow Jones US Dividend 100 Index, and one of its most important requirements is that companies must have paid dividends for at least 10 consecutive years before they can even be considered for inclusion. That single rule excludes many speculative companies and businesses that have never proven they can continue to reward shareholders during difficult economic periods. What remains are established companies that millions of people interact with every day, including Texas Instruments, United Health, Qualcomm, Chevron, Coca-Cola, Pepsi, Verizon, Procter & Gamble, and Amgen. These companies may not dominate financial headlines, but they have demonstrated an ability to survive recessions, financial crises, pandemics, inflationary periods, and changing interest rate environments while continuing to pay and grow dividends. Another advantage is this fund's remarkably low cost. SCHD charges an expense ratio of just 0.06% annually. Considering that the median ETF charges approximately 0.5%, SCHD is about 88% less expensive than the average fund. On Bobby's $45,000 investment, that works out to roughly $27 per year in expenses, a cost so small that it is almost invisible. However, the most impressive part of SCHD is not its low fee, it is its consistency. SCHD has paid a dividend every quarter for 14 consecutive years. It continued making those payments during the COVID-19 pandemic, through the 2022 bear market, and during periods of economic uncertainty and rising interest rates. Even more impressive, SCHD has increased its dividend for 14 consecutive years. Over the last decade, the fund's dividend has grown at an average annual rate of 10.43%, while the share price has appreciated 136%. That means investors benefited from both rising income and rising portfolio values over time. When Bobby compared SCHD against the standards he established at the beginning, the results were difficult to ignore. The fund offered a dividend yield of 3.29%, dividend growth averaging 10.43% annually over the last decade, price appreciation averaging 8.45% annually, and a 14-year track record that included multiple bear markets. Every box was checked. Unlike the other funds on his shortlist, SCHD did not force him to choose between growth and income. It offered both. Of course, identifying the right ETF is only the first step. The real question is what happens when time and compounding are allowed to work together. To answer that question, Bobby ran a simple projection. He invested the entire $45,000 in SCHD, automatically reinvested every dividend, and never contributed another dollar. There would be no market timing, no trading, and no additional investments. Just one lump sum investment and decades of patience. By year 10, the account is projected to reach approximately $140,630. Annual dividend income is projected to be approximately $4,902, or about $408 per month. Bobby's original $45,000 investment has more than tripled, and the reinvested dividends are purchasing a growing number of additional shares every quarter. Those shares then generate their own dividends, creating a powerful cycle where income produces more income and growth fuels additional growth. By year 20, the transformation becomes even more significant. The portfolio is projected to reach approximately $469,332, while annual dividend income climbs to approximately $19,793. That equals about $1,649 every month. At this point, a one-time investment made 2 decades earlier is producing more monthly income than many households spend on groceries, utilities, subscriptions, and vehicle payments combined. Bobby still has not sold a single share, nor has he added another dollar to the account. Then comes year 30, when the full power of dividend growth and compounding becomes clear. The portfolio is projected to reach approximately $1,705,727. Annual dividend income is projected to reach approximately $86,717, which translates into about $7,226 every month. Remember that Bobby's original goal was to replace the average American's after-tax monthly income of approximately $4,100. SCHD's projected monthly dividend income exceeds that target by more than $3,000 per month. What makes this result even more remarkable is that the portfolio generating the income remains intact. The account is still worth more than $1.7 million. Bobby has not spent down the principal, liquidated assets, or sold shares to generate cash flow. The portfolio continues producing income while remaining invested and capable of future growth. This highlights a concept that many traditional retirement plans fail to emphasize. Most retirement strategies focus on accumulating assets and gradually spending them throughout retirement. A dividend growth strategy focuses on building a portfolio that generates income while preserving the underlying investment. One approach slowly depletes the asset base over time. The other seeks to live on the cash flow while allowing the assets themselves to continue growing. Despite the attractiveness of these projections, most investors never experience results like Bobby's. The reason is rarely a lack of money or access. Anyone with a brokerage account can purchase SCHD. The real challenge is patience. Compounding often appears disappointingly slow during the early years. Many investors become impatient during this stage and begin searching for shortcuts. They chase funds offering 8% yields, jump into investments with impressive short-term performance, or attempt to time market movements. Every interruption slows the compounding process, and every unnecessary change can cost years of future income growth. The investors who eventually achieve outcomes similar to Bobby's are usually not the ones making constant adjustments. They are the ones who remain consistent. They reinvest every dividend, stay invested during bear markets, and understand that market declines often allow reinvested dividends to purchase more shares at lower prices. They trust the process and allow time to work in their favor. You definitely do not want to watch this opportunity from the sidelines. So, please let me know your plans in the comments below. Now, if you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Listen, if you want to know the 5 best Fidelity index funds to buy and hold for life, or the 5 best high-yield ETFs for monthly dividends with zero NAV erosion, check out the videos on your screen right now. Thank you, my friend.